Hey gang, welcome to Time in the Market Investing channel with a long-term focus. Taking a look at Celsius Holdings, stock is down 30% plus year to date, beaten up quite a bit since May where they were close to 95 bucks, now trading in the low 40s, so down more than 50%. Celsius makes energy drinks akin to Monster, akin to Red Bull. They're the third largest player in the United States as of today, so they've taken some decent market share from those two larger players. But the concern is that they're starting to slow. There's some data here that shows that their market share is normalizing, not growing as much anymore. There's a general slowdown in the energy drink space that investors are concerned about. And there was also some news that Pepsi, which is their distribution partner, is actually normalizing their inventories a little bit, reducing them for 2024, probably because they see the slowdown in the energy drink space and they likely over inventoried in 2023. So that's all impacting their results. As you look at their 2024 results, Q1, pretty solid, but again, some concerns developing there, which is causing the stock price to go down, and that's continuing. The momentum here is obviously very bad, but the question is, does this lead to an interesting valuation at today's prices, or does it have more room to fall? Is it a stock I'd want to buy? I have been interested in Monster, looking for a good entry point there. Those guys released their earnings this week as well, but again, both of these companies are in a space that's starting to slow a little bit. And if we're heading into a recession, some of these discretionary expenses like energy drinks are probably going to suffer a bit more. And that's potentially already being seen as consumers struggle with what they spend their money on and a tighter wallet. So a couple of things to note about Celsius. In 2022, they signed a long-term distribution agreement with Pepsi. They gave Pepsi 7.3 million preferred shares that are convertible into regular shares. That's about 8.5% ownership in Celsius. And they do pay Pepsi a 5% dividend on those shares. That's similar to the agreement that Monster has with Coke. Coke owns about 20% of Monster, and they basically help them distribute their product all around the world. And you basically need that as an independent company. And that's really what helped Celsius grow their revenue so much, because they were able to expand their distribution network so much through using Pepsi's best-in-class capabilities. So as we look at the earnings themselves, there's a lot of good data in a lot of these earnings. If you are interested in the energy drink space, even if you're invested in Monster, you might want to look at what Celsius is saying, because it'll tell you what Monster might be doing. So you can kind of see that Celsius is basically showing you that the energy drink space is slowing. 13% growth, 5% growth, 8% growth in the last 3 years, now down to only 3% growth. But that is still much better than the total beverage spend and the total beverage growth across the board, which is why the energy drink space is so interesting, because the growth in the energy drink space is so much better than other beverages, and that's why these stocks have done so much better. The nice thing about Celsius and why they've done so well is that they've driven a big portion of this energy drink growth in the last couple of years. You can kind of see that in 2019, energy drink growth was driven by mostly non-Celsius brands. So 0.5% of the growth was driven by Celsius. By 2024, 46.5% of the dollar growth in the energy drink space is driven by Celsius. So that's why the stock has done so well, because their overall growth on the revenue side has been amazing. And a lot of that is basically distribution. A lot of that is getting their product out in front of the customer. You can kind of go into the store and they have really good shelf space. Some of that might be changing now. You can see a little bit of their market share maybe normalizing or even dropping in the last couple of months, which is a concern for investors. But they've really done a good job, at least historically, in taking market share, in growing their brand, in getting out there in front of customers. And a lot of that is because, again, there's more interest in sugar-free drinks, and they've done a really good job of kind of doing the healthy, sugar-free energy thing. And, you know, whether it's better for you, whether it has natural ingredients, there's some lawsuits here and there. There's some questions here and there around some of that stuff. There's a lawsuit around them using the term no preservatives. I don't think that really matters to the casual consumer, but it's something to keep in mind as an investor, because it may impact their business on a go-forward basis. They are starting to expand globally, started Canada sales in January 2024, moving into the UK and Ireland, mostly in the fitness area for now, not really in stores, then moving into Australia, New Zealand, France in the second half of 2024. The Problem here, though, is that their international business is still super tiny, and it's probably not growing as fast as I would like it to grow. We'll talk about that in a second, but it's still, for how small that business is, you'd think it would be growing faster with all this expansion, but it's not really quite there yet. However, in the United States, they're still doing relatively well, expanding their shelf space. They're saying that's about 35% expansion. Most stores are selling about 20 SKUs, so individual items, versus 15 last year. So that's obviously going to help. Margins are expanding. They are free cash flow positive. They do pay that dividend, but in general, their balance sheet is really solid. So if you look at their overall financial highlights, again, revenue up 23%, 29% for the first half of the year. So slowing sequentially, which is not a good thing, which is why the stock was down a little bit during the quarter. But North America is still growing, even though it's a substantial sized business already. However, like I said, international only up $4 million, only up 30% off of a base of 15 million. Again, they're not really fully international yet, but I would want that to start ticking up faster, because I'm pretty sure that North America, with a combination of their market share already being into the low teens and the energy drink market slowing down in general, is probably going to start slowing. So if they want to keep that 20% growth up for the year, they probably have to offset that with better international growth, and hopefully we start seeing that in the next quarters ahead as they expand. So you can kind of see their revenue and where it's gone and where it's been. Again, this is a company that has exploded in growth, so that's why the stock is where it is. They're an 11.4. Their brand share is 11.4%, third behind Monster and Red Bull. Monster has some additional brands that they have on this list, but there are other brands out there. This has become a more competitive space. In the past, it was kind of just Red Bull and Monster and maybe some small brands, but now that Celsius has grown, C4 is growing, Ghost is growing, Alani is growing. A lot of these brands are growing, not at the same clip that Celsius is growing, but the more options there are, the harder it is for one individual brand to take market share. Red Bull and Monster have lost market share to brands like Celsius, but the question is going to be, can Celsius continue taking more market share, or will they start normalizing that? You can kind of see Celsius's market share here. It's basically flat quarter over quarter on an energy dollar share here. If you look at some of these other data points that kind of go past the quarter, you can kind of see that Celsius here is starting to drop a little bit, which is concerning, I think, as investors look at some of this stuff. This has been a trend that's been primarily northward, upward on both of these graphs, and now it's starting to either normalize or maybe even drop a little bit, and that's certainly concerning, and that's primarily the reason that the stock is where it is right now. And investors have to sort of say, well, what's going to make up for this standstill if it's not taking market share and the energy drink space is shrinking or starting to grow less in general? This is a company that's still trading at a decent multiple. You sort of look at the multiples here. They're based on the fact that this company has grown at 140%, 108%, 101%, and now the expectations are low 20s. And maybe it'll pick up again as international expands. But the valuation here is somewhat rich if this growth is going to now start falling off the cliff. Because if it's 20% and another 20% and another 20%, it's probably worth it. But if it's 20% and then suddenly it's 15 and it's 10, the valuation might be a bit expensive. However, if you look at the valuation against a competitor like Monster and you give it the benefit of the doubt and say, well, right now, after this massive drop, Celsius has, on a next 12-month basis, only slightly more expensive than Monster, even though Monster is growing in the high single digits, maybe low teens, versus Celsius growing in the low 20% range. On a PE basis, again, more expensive. On a free cash flow basis, again, slightly more expensive. But valuations are now getting more interesting for Celsius than maybe even Monster. However, Monster has a longer-term partnership with Coke. They've been a long-term brand. They've developed it, and it's probably sticking around. They have more brand cachet than Celsius. Celsius is probably a brand for the last 3 years that people have known. The question is going to be where they go from here. Can they introduce new drinks? Can they introduce new products? Can they expand from where they are today and become something akin to Monster. Because if they can, and I'm not saying they need to have 30% of the market share, because you can't have three companies having 30% of the market share. They have to take it from somebody else. One, can they fend off some of those smaller competitors, Ghost, C4, etc., Alani? Two, can they continue taking small incremental market share from Monster? Because if they can and their expansion into internationally goes relatively well, this could still be a really interesting investment at today's prices. As we look at the valuation, guys, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So a couple of things. 9.4 billion market cap, debt and balance sheet is really solid. They basically have $800 million in cash, almost no debt. They can certainly institute a stock buyback if they want to. Note that they are free cash flow positive in 2023, $123 million in free cash flow. About $23 million of that was stock-based compensation and issuing shares. So maybe a little bit of dilution. They're not buying back shares right now, but not a ton of dilution, which is good to see. And two, do note that they have those preferred shares from Pepsi. This enterprise value does not include those preferred shares. This one does. And they pay a dividend of 5% to Pepsi, and that amounts to about 28 million bucks a year. So no dividend right now. Don't expect them to pay one anytime soon. They're investing in growth. That's what they should be doing. They do have a balance sheet that supports that. They don't have to take on any debt. They have a business model that does as well. Free cash flow margins are in the mid-teens already. As I look at their growth potential, I'm being a bit more conservative than some of these estimates. Ignore the estimates for 27 and 28. There's only like one guy doing those estimates, but I'm basically saying that they're going to have to grow in the 20% range for probably the next 2 years, including this year, and then start dropping a little bit into the low teens by 2028. And again, remember, Monster is a business that has $7 to $8 billion in overall revenue and is still growing in the low teens. So it's not crazy they'd be growing in the low teens at a revenue that's sub 3 billion, as long as the business continues, taking a little bit of market share, expanding internationally. And then margins are improving into the low 17% range. And this is reasonable. Maybe not in this 5-year period. You can disagree with that, but Monster has margins in the low 20% range. So I think long-term, a company like Celsius can reach those, especially once they start focusing more on margins and less on investing in expansion, which might happen 5 years from now. If you want to play around with these numbers, hit file, make a copy. The link will be in the description down below. I'm assuming in the next couple of years, they'll institute a buyback, a small one, only 10% of their money going towards buybacks. As I look at valuation, again, I think as you mature, a company like this will get into that 3 to 4% range. I'm putting 50% on each. That's 3 to 4% free cash flow. Right now, this is trading on a go-forward basis, assuming these margins, at about a 3% free cash flow yield as well. So not 2.5 rather. So maybe getting a bit less pricey than it is today as growth slows, which makes sense. You can kind of look at Monster as a comparable. They trade in that 3 to 3.5% free cash flow yield range. So maybe I'm being conservative here, but Monster is a better brand name. That's why I'm giving that a bit of a better multiple than this. With all this in mind, with these assumptions, gets me to an expected return from today's prices of about 9.5%. Kind of makes sense to me. So if I'm looking at a 10% target return, a fair value of about 39 bucks, basically says that, in the long run, this will kind of hit that, $50 to $70 range without a problem in the next couple of years, give you a 10% return based on these assumptions. These assumptions are maybe somewhat aggressive because you never know what happens with a brand like this. Brands can flare up and die just like that. Right now, I think Celsius is in a good spot where they're still growing. The expectations aren't amazing growth, but they're decent growth. You're still basically doubling your revenue from where it is today to where it's going to be 5 years from now, which, some may or may not consider aggressive. If you feel like the valuation should be more aggressive here at a 3% yield, the fair value gets to about a $45 price point. If you want to be a bit more conservative here, get a 15% target return, you get into the low 30s with these assumptions. But this doesn't seem like it's ridiculously priced, right? This has gotten to a point where the market's gotten relatively pessimistic about their prospects. The earnings are certainly deaccelerating on the revenue side. Their margins are still pretty solid, but the reality is they have to keep expanding those for this valuation to make sense. And this is still a $10 billion market cap company. So, when you compare it against Monster, that's kind of your goal as a long-term company here. Like, can this become the next Monster? And if it can, this could be a $50 billion market cap company pretty easily. The question is going to be, where does their partnership with Pepsi go? I could certainly see Pepsi saying, well, we've taken down our inventories, the stock has gotten beaten up. Maybe we double our holdings of Celsius and become more of a partner. Is this a potential acquisition target for somebody in the future? Some of these larger drink companies, if they really want a brand name on their books without just having a small holding of them in the energy space, this is the way to do it. There's Rockstar, there's some of these brands that are owned by Coke or Pepsi, but those aren't doing very well. It's really Monster, it's Red Bull, it's Celsius, and it's some up and comers. And then the other question is going to be, and that hasn't been answered yet, where's their international expansion? It's not quite there yet, but that's the upside here, right? They really have to just take a little bit more market share from Monster and Red Bull, keep some of these other competitors away, keep releasing new flavors, maybe some new, drink mixes. If they're a healthy brand, why not a 100 milligram caffeine release for people who want less caffeine? Are they potentially going to be in the, THC space once that's all legalized? That's an easy mix. Caffeine plus THC. Wow, amazing. So there's a lot of upside here, especially as you kind of think about what the future prospects are. And those future prospects are mainly on the international side and mainly on the, United States margin expansion, slight growth side. And that's sort of where I am here. Would I be a buyer here? No, probably not yet. I still feel like the momentum here isn't fantastic, and I don't think I got enough out of these earnings, especially with some of this stuff around potentially losing market share in the United States, which is their primary market. That worries me a bit. But if this stock dips a little bit, I could see them saying, hey, we're going to announce a share buyback. We're going to really invest in the business. We're going to expand internationally. And from there, that could potentially take off. But for me to kind of get into this, because this is such a short window brand, meaning that it hasn't been around that long, if it drops into the mid to low 30s, I'd probably pick up some shares. But in the low 40s, I'm just saying that this is pretty much fairly valued. This doesn't stand out to me as like an amazing deal, but it also doesn't stand out as a bad deal. So if this starts moving in the other direction because the market's dynamics change and one piece of news comes out that shows that they're taking market share again because this stuff moves month to month, or if Pepsi makes an investment here, or if they start buying back shares, there's plenty of things that could send it northward. But for me, I just, I don't know enough about the industry yet to get invested. But as I look at these earnings more and more, and as I learn more about Celsius and Monster through their earnings, I'll probably take another look at this and revisit. So what do you think? Am I wrong on Celsius? Am I missing anything here? Let me know down below. Thanks for watching. Like, subscribe, all of that good stuff. Bye.